Well, what started it all is COVID. We were sitting around considering what is going on. Supply chains are disrupted, inventories are depleted, you come to the store, there is nothing there. Why didn't companies prepare for that? And then we thought maybe they faced a trade-off, there is no free lunch. If they shifted resources to hedge against this operational risk, they would have less resources left, less liquidity left, less cash left to hedge against financial risks. So we thought maybe the companies have a trade-off. They have to trade off the hedging against operational risk with hedging against financial risks. And we in finance study only, or we focus on financial risk, but there is also operational risk. The company has a commitment to pay off its debt, but it also has a commitment to deliver to its customers. And if it doesn't, there is a penalty. What is the penalty? It loses customers, loses franchise value, customers shift to another supplier, and so on. So what should companies do? And then we thought about the problem that the manager is facing. Cash is coming in. What should I use it for? Should I hoard it to be able to pay off the debt? Or should I spend it on inventory, on excess capacity, on excess labor, on supply chain diversification? But then there's less left for hedging against financial risk. And then there is greater financial risk and the possibility of default. So how should I trade off these two things? And this is what the paper is all about. The trade-off between hedging against financial risk and the hedging against operational risk. The financial default may end the life of the firm. The operational default may inflict a penalty on the company. The question is how large it is. And in fact, this trade-off does not exist in a liquid, well-functioning market when companies can raise the necessary resources to bridge the shortfall in cash in case there is one. For example, suppose there is a negative shock to cash. The company may have a problem raising the resources, paying off the debt. If the company can pledge its future income and borrow against it, it can make good on its current financial obligations. However, if the company cannot borrow, and this is what we call in finance the company being financially constrained, then it needs to calculate, should I hedge against the financial risk or should I hedge against the operational risk? And this is the tension here. I should say that what happened during the COVID-19 crisis is consistent with what we model, and the reaction of the policymakers was appropriate. What it did, it injected huge liquidity into the market. This enabled companies that had shortfall in cash to borrow against future delivery of goods and services and bridge the gap and be able to make good on their financial obligations. Had companies not been able to do that, then we would have seen greater negative real impact on the economy. That is to say, companies would cut more their production, more than operational hedging, just to make sure that they are able to pay off their debt. My recommendation to companies is make sure you have a channel of borrowing or raising capital as a substitute for a shortfall in cash flows. If you are not financially constrained, there is no problem. If you are financially constrained, then you may ask yourself, I should develop means to pledge my future income, my future delivery, and being able to borrow against it for the time being in case I have a shortfall in cash. For policymakers, I would say make sure companies have sufficient liquidity in case of negative economic shock to be able to bridge the gap and pay off debt and not cut into real economic activity which has macroeconomic consequences.